The decision to sell a stock can be difficult. Do you sell it for a profit now that the price has risen? Do you sell it now that the price has fallen? You should cut your losses, you know. Should you sell it because it has been flatlining while all your friends are becoming wealthy from Bitcoin? Fortunately, the Oracle of Omaha and financial sage Warren Buffett has us covered on this front. The world's greatest investor has discussed the art of selling on numerous occasions. This video will walk you through 3 real-world scenarios in which you should sell your stock market holdings in the manner of Warren Buffett. Furthermore, if you've only heard what Warren Buffett has just said on the subject, you're most likely doing it incorrectly. This is the Swedish investor, and I'm here to provide you with the best techniques and tools for financial independence through stock market investing. Before we get into the 3 reasons why you should sell a stock, let's first discuss why the character in the beginning does it incorrectly. It's because he's overly concerned with how much he paid. One of the most fundamental qualities of stocks, according to Buffett, is that the stock is unaware that you own it. You're overcome with emotion as a result of it. You can remember how much you paid. You remember who told you about it. You know all these minor details, and it's not concerning in the least. It just sits there. And so, someone paid $100 for a stock that was only worth $50, and they feel terrible. $10 was paid by someone else, and they are happy. All these feelings, and it couldn't possibly matter less. Okay, so what factors, if any, should you consider when deciding whether to sell a stock whose price has risen, fallen, or is merely fluctuating? The first scenario for when Warren Buffett wants to sell is as follows. When a better option materializes. Nearly every time I decided to sell in my first 20 years of investing, if not longer, I did it because I had found something else that I was thrilled to buy. That is, I sold stocks at 3 times earnings to buy stocks at 2 times earnings. You already know how much I like talking about opportunity costs. If you buy the stock of Company A, you cannot invest the same amount of money in firm B's shares. This can lead to unpleasant decisions, such as leaving a firm you genuinely enjoy for something better. Here is an excerpt from Buffett's 1959 letter to the partners of Buffett Partnership Limited when he was transitioning from a job at Commonwealth Trust to Sanborn Maps. Late in the year, we were successful in locating a one-of-a-kind situation. We sold our Commonwealth block for $80 a share in order to become the largest holding at a reasonable price. I'd like to point out that $80 stock buy could anticipate to do well over time. However, the relative undervaluation at $80 with an intrinsic value of $135 differs significantly from a price of $50 with an intrinsic value of $125, and it appeared to me that our money could be better spent in the situation that replaced it. If you followed Warren Buffett's recent advice, here's where your selling may have gone awry. He would not sell his completely owned company now, even if the financial returns were mediocre. The claim that Warren Buffett's favorite holding period is forever is a little misleading. Holding forever is simply a personal preference of his these days. He favors the personal bonds he's been able to form with the management of Berkshire Hathaway's subsidiaries above a few extra percentage points of return. Breaking up with people I like and people who have joined me because they believe it is a permanent home. Berkshire doing so just because someone waves a big check at me would be the same as selling one of my children because someone waves a big check. As a result, I'm not going to do it. And I'd like to inform my partners that I'm not going to do it so they aren't disappointed in me. The Berkshire Hathaway Owner's Manual was first distributed to Berkshire shareholders in an annual shareholder letter in 1983, but Buffett's ideas date back far further. Consider what he said in a 1968 partnership letter. As previously indicated, permanent ownership of managed corporations can earn as much money as purchasing and reselling such businesses or skilled investment in marketable assets. Nonetheless, they give a pleasant long-term sort of work at acceptable rates of return when undertaken in partnership with high-quality, talented people. Buffett's preference for reselling enterprises began to evolve after an experience with Dempster Mill Manufacturing in the early 1960s. My whole community resented Buffett for buying their big company and then cutting costs and people to make it more profitable for a sale. However, if we look at his partnership letter from 1961, when he was also working with less capital, we can see what I believe Buffett would tell us tiny investors to do. Our mainstay is to buy cheap securities and sell them when the undervaluation is corrected. It has nothing to do with you, Sonny. It's all about the money. Another reason Warren Buffett would sell a stock is as follows. When the economic characteristics of a corporation drastically change, our tendency is not to sell things until we are really displeased with the management or believe that the business's economic qualities have altered considerably. This type of stuff happens. Consider the following important changes that have previously prompted Warren Buffett to sell. He recently divested his shares in a few significant airline companies, stating that the world has changed for airlines as a result of the coronavirus. Buffett sold the Washington Post, one of his most valuable holdings, in 2014. For many years, Buffett lamented how the world had changed for newspapers, and how the Post no longer had nearly the same competitive advantages that it did when Berkshire purchased it in 1973. He eventually decided to drop it. Then there's Buffett's interest in Tesco, the retail chain. Buffett does not explain why, but he had a problem with the company's management, which caused him to sell his interest. He left the role in 2014, making a tiny net loss. On a more personal level, if I had known about one of my greatest investing selling mistakes a few years ago, I could have avoided it. I used to own Kopparbergs, a Swedish beverage company that made more than half of its revenue in the UK. Britain chose to leave the EU in July 2016, affecting trade with the rest of the EU. Some could say I should have sold sooner rather than later. It's completed, but I must add the following. Fundamental shifts are uncommon. In his annual letter to Berkshire Hathaway shareholders from 1997, Buffett mentions that selling good companies on scary news is usually a bad decision. Finally, while Buffett and I both believe in a focused portfolio, there are occasions when you must sell or, well, trim back. When a single holding becomes excessively large. Yes, the adage "don't put all your eggs in one basket" is correct, but it doesn't have to be as strict as most people suggest. The more money you can put into a single stock, the smaller your portfolio. Consider this. Warren Buffett invested 40% of his partnership's money in American Express in 1967 when he was managing more than $500 million. The stock eventually pushed him over the 40% limit, prompting him to reduce his holdings in order to maintain some level of diversification. American Express is Warren Buffett's fourth largest investment. Again, the person in the video's intro is mistaken because he is preoccupied with the purchase price. A stock is unconcerned about how much you paid for it. A good question to ask is, would I want to invest now if I didn't already own the stock? If not, you should probably sell. Keeping a stock and wanting to purchase more of it are not synonymous, but they are related. They are not the same thing, because selling a stock to purchase another requires you to pay taxes on your profits as well as transaction costs. As a result, there is a small difference between the buy more and sell more zones. This is the do-nothing zone, which is extremely undervalued in today's investing world. If you've discovered something better, something fundamental has changed, or a single holding has grown too large, sell it. You now comprehend the selling aspect. If you want to know what Warren Buffett looks for when he buys a stock, here's a long video with a lot of meat. This section will teach you about Warren Buffett's 25 most important investments of all time. You'll see how these investments appeared when they were purchased. Guys, cheers, and we hope to see you again soon.